In March of 2026, the quietest corner of Wall Street erupted. $265 billion in market value vanished from the titans of private lending in a matter of weeks. This wasn't a classic bank run. It was a digital stampede that exposed the cracks in a $3 trillion shadow banking machine. Built after 2008, never tested, it promised fortress-like returns. Now, with gates slammed shut, we ask, could this opaque market meltdown become our next systemic crisis? We'll trace private credit's hidden rise, its seductive liquidity promises, and the terrifying question now looming over Wall Street and Main Street. In 2008, the global financial system shattered. Banks, battered by toxic assets and a regulatory reckoning, began a historic retreat from risk. It wasn't just a tightening, it was an evacuation. Over the next 2 decades, a staggering 75% of U.S. banks simply vanished, leaving behind an urgent, massive vacuum in the lending market that businesses had relied on for generations. So if a bank won't lend to a mid-sized company, a manufacturer, a hotel chain, a regional retailer, who will? Into that void stepped a new kind of lender, silhouettes moving through the empty marble hallways of traditional finance. Small, agile investment firms, unburdened by the same rules, began writing loans directly. They called it private credit, and it sparked a gold rush in the shadows. So what actually is this shadowy world? Let's strip away the jargon. Private credit is, at its core, a direct handshake between a big money investor, like a pension fund, and a borrower. No stock exchange, no ticker tape, and crucially, no transparency running through a public clearinghouse. It's a private deal, struck in the dark. The big sales pitch for this handshake deal is something called the liquidity premium. The logic is simple. If you lock your cash away in an asset you can't easily sell, you get paid handsomely for your patience. Higher risk, higher reward. That pitch worked. Charts tracking its growth are just a vertical line. After 2008, this was a niche backyard operation. By early 2025, it had ballooned into a $3 trillion behemoth. And the biggest Wall Street titans were all in: Blackstone, Apollo, Blue Owl. They weren't just dabbling, they were dominating the scene. With projections aiming for $5 trillion by 2029, it felt like the only direction was up. But whenever you see returns that good come out of the dark, you have to ask the same simple question. What's the catch? The catch is the engine itself. The structure is built on a raw trade-off. You get that delicious yield, but you sacrifice the ability to get your money back on a bad day. That's the illusion we'll pick apart next, where those smooth daily valuations meet a very frozen reality. The innovation that fueled the boom was the semi-liquid fund, a cleverly packaged vehicle designed to give Main Street retirees a taste of private credit's juicy returns, with the promise of getting their money back every quarter. But how can a fund holding years-long, hard-to-sell loans promise you quarterly cash back? The answer lies in redemption gates and withdrawal caps, the fine print that says we'll only let a small fraction of investors out at a time. For instance, BlackRock's fund enforces a 5% quarterly gate, meaning if everyone wants out, only 1 in 20 gets their money. Jamie Dimon saw the red flags early, warning that looser underwriting and opaque ratings in these illiquid vehicles were setting up a familiar disaster, a replay of the mortgage-backed securities meltdown. The stage was set for a moment when that quarterly promise would be tested, when a wave of redemption requests would slam into those gates and reveal whether the liquidity was real or just a mirage. The tremor that triggered the great stress test came in April of 2026. Fitch dropped a bombshell. The U.S. private credit default rate hit a record high of 6%. For an industry built on avoiding losses, this number was a 5-alarm fire. And almost immediately, the cracks in the semi-liquid structure became visible. Take Blue Owl Capital. This was not a small corner shop. They permanently slammed the redemption gates shut on their $1.6 billion OBDC2 fund, trapping investors inside. To get cash for the few they did let out, they had to dump $1.4 billion in loan assets into a market that had no buyers. BlackRock wasn't far behind, enforcing its 5% gate on another fund. It was a real-world bank run in slow motion. But here's the dark secret buried in that 6% number. It was arguably a lie. Moody's estimated that a staggering 65% of all 2025 defaults weren't outright failures. They were distressed restructurings, a fancy term for kicking the can down the road, burying a ticking time bomb in the garden. The market finally saw through the illusion, resulting in a historic sell-off. From their peaks, Apollo plummeted 41%. Blackstone and Ares both lost nearly half their value. And Blue Owl? It was utterly gutted, down by 2/3. In total, the panic erased over $265 billion in market cap, a tremor that was already building into a contagion. But the real fear isn't just the funds themselves losing money. It's that they're tethered with invisible steel cables to the entire financial system. JPMorgan alone has a direct exposure of $22.2 billion. Deutsche Bank disclosed a staggering $30 billion stake. These aren't investments in a vacuum. They are a live wire connecting private credit's opaque world directly to the commercial banking system. And no one has any idea what happens when you cut that wire. The IMF has issued a structural warning so blunt, it's almost frightening. This market has never been tested in a severe downturn at its current size. Its entire risk mitigation playbook is effectively an unproven hypothesis. If something goes wrong, we might learn a new, terrifying phrase. The FSB outlined a specific downward spiral scenario. Opaque valuations force fire sales, which in turn force brutal price discovery, which then forces even more losses, collapsing the market in a self-reinforcing doom loop. It's a financial black hole, yet we're being told two completely different things at once. The Federal Reserve publicly assures us that this poses no systemic risk to banks, but the IMF warns that its opaque, exponentially growing nature is a systemic vulnerability by definition. These two statements cannot both be right, and the only way to find out who is wrong is the one test nobody wants. The shadow banking system wasn't built on law, it was built on math and trust is a domino that falls in seconds. We've seen the blueprint for contagion hiding in opaque glass and locked doors. If you want to keep a light shining in these dark corners, make sure to subscribe and ring the bell. Thanks for watching.